What if I told you about a business with strong network effects and 200 times year on year revenue growth that was preparing to offer a 25% dividend and implement a permanent share buyback program? Is that something you might be interested in? Now, given that this is a cryptocurrency channel, just so you know, the project that I'm talking about is a really big project and it's a really big cryptocurrency and it's not Bitcoin. Want to make money in crypto? This is Token Metrics. Token Metrics helps crypto investors build profitable portfolios using artificial intelligence-based crypto indices, trading indicators, rankings, and price predictions for more than 6,000 crypto assets. Hi everybody, this is Crypto Rich, working with you to get rich with crypto, filling our pockets with crypto profits. And in this video, I'm referencing an article from Zero Hedge. I've been a long-time reader of Zero Hedge, which is a really great news aggregation site, taking all sorts of interesting articles from all over the web. And what I applaud about Zero Hedge is very often it's ahead of the curve and it has a very potent anti-war stance. As a news aggregation site, it draws on articles from all over the internet, and I've actually gone to the original, and I will link to this in the description below, and I invite you to go and subscribe to this blog. It's a really, really interesting blog with some really great in-depth articles on cryptocurrencies. And this article is Own the Internet, the bull case for Ethereum. Now, I'm not going to go through the whole thing. I'm just going to go through some particular points that struck me as the author, Packy McCormick, lays out the case of why Ethereum is such a great long-term play. Now, he starts off by describing Ethereum as a world computer, which it is. It is programmable money in a decentralized fashion all over the internet, so it's global in that sense. It is the settlement layer for Web3, the backbone of a decentralized internet. And the Ethereum blockchain's cryptocurrency Ether, ticker symbol ETH, is a bunch of things too. It is internet money. It confers ownership of the Ethereum network. It generates yield, it's a store of value, and it's also an investment on more on-chain activity. You know, I hold some ETH because I think it's going to go up in value, and that rise in value is going to be a function of the increase in demand for Ethereum, which is a function of its role as programmable money. Now, McCormick makes the point that Ethereum is complicated. Bitcoin is simple. I mean, Bitcoin is digital gold. It's a store of value. It just sits there and kind of like does nothing. Now, that's not to knock it. It's immutable. It's the most decentralized asset in the world. It's the original gangster of the cryptocurrency space, and it's the hardest one to attack. As long as enough people agree upon the value of Bitcoin as a store of value, as a means of transfer of exchange of value, then it's always going to have value. Bitcoin fulfills this purpose really, really well. Now, McCormick points out a few things that have happened lately with regards to Ethereum, which have given him cause for optimism with regards to Ethereum as a long-term hold. So first, there's been a use case explosion with DeFi's, NFTs, and DAOs emerging as real use cases for Ethereum and having grown spectacularly over the past year. Then with the upcoming implementation of EIP 1559, which I'm going to talk about in a little bit, Ethereum is going to become deflationary, which is going to make it ultrasound, not just sound money, but ultrasound money. There's also ETH2, which is currently running a test chain that will merge with the main Ethereum chain in about 6 months' time. And when that happens, Ethereum is going to switch from proof of work to proof of stake, and more value is going to accrue to ETH holders. And finally, the narrative around Ethereum is gaining steam and growing and growing and growing, which I think in part is to do with the increase in use cases and the increasing number of decentralized applications being built on the Ethereum blockchain. Now, McCormick makes an interesting comparison with Excel and Ethereum, which I thought was really, really interesting. And he says there's two things that are common to both. So one is Turing complete. So if something is Turing complete, it means that it can solve any reasonable computational problem. Now, with the introduction of Lambda, which lets users create their own formulas, Excel has become Turing complete. Now, with Ethereum, you can write smart contracts, the equivalent of formula on Excel, that can solve any reasonable problem. And then the other thing that XL and Ethereum have in common is composability. In XL, you can chain functions, passing the output of one function as the input to another, allowing for an enormous number of potential computational pipelines. So for example, I could have a function that is, in one cell, A plus B, and in the second cell, divide the sum of A plus B by C, and then the third cell, multiplied by D, and so on and so on and so on. Now, each time XL adds a function, the power and flexibility of XL is multiplied, since that new function can be chained to a large number of existing functions. Now, this is very similar to the idea of composability or ex-legos on Ethereum, because Ethereum, you can have one smart contract that leads onto another smart contract that leads onto another smart contract, which makes it flexible and composable. Now, XL is Turing complete and composable, which gives it a great deal of flexibility. And as a result, for all these companies that have built applications or using XL in some way or another, which have a market cap of over $500 billion. Now, the equivalent could be all these decentralized applications that are built on the Ethereum blockchain. This website lists over 1,000 of them, and here are just something like 250 or so. Now, this is what's happening with Ethereum. As a function of its flexibility and its composability, there has been an explosion of real use cases for Ethereum over the last year or so. Just look at this year-on-year chart, quarter 120 versus quarter 121. So the transaction volume in quarter 120 was $33 billion. In quarter 121, $713 billion, an increase of over 2,000%. The transaction fees over the same period have increased by 20,158%. Now, I don't mean individual transaction fees. I mean, cumulatively, there's just so much more happening on the Ethereum blockchain this year than there was last year. There's been a 71% increase in the daily active addresses from 354,000 to 607,000. Even the number of Bitcoin transactions in the form of wrapped Bitcoin have increased like crazy over the Ethereum blockchain. Now, if you don't know what wrapped Bitcoin is, you send Bitcoin to certain exchanges or DEXs, and what happens, it gets converted or wrapped into an ERC20 layer, which then allows for you to transact it on the Ethereum blockchain. And there's been a 9,468% increase in the number of transactions of wrapped Bitcoin. And as for NFTs, oh my God, over 56,000% increase in sales of NFTs in quarter 121 versus quarter 120. Another measure is the amount of volume traded on decentralized exchanges. Like in the first 3 weeks of May alone, May 2021, Uniswap and SushiSwap did $78 billion worth in transactions. Now, there are challenges with the Ethereum blockchain. It is slow, doing something like 19 transactions per second, whereas Visa can do 1,700 transactions per second. The other problem with Ethereum is that it's really, really expensive. I mean, here he gives a transaction cost of about $5 in gas fees. I know lately it's been up in tens and 20s and sometimes even $100 to transaction with Ethereum. What doesn't help are the gas fees volatility, because they're auction-based and they change based on demand, which makes it hard to transact with any confidence or predictability. Ethereum, unlike Bitcoin, is inflationary. There is no hard cap on the number of ETH that could theoretically be minted. And proof of work requires minting a bunch of new ETH, which means growth leads to dilution for existing ETH holders because new supply is always being added. Plus, the other thing that happens with the new ETH that it's minted is that the miners have to sell the ETH in order to pay for their costs. So you have new supply and you have new supply being sold. And then finally, it's unfriendly. Mining Ethereum as a proof of work coin means using a lot of electricity. However, there is some good news. EIP 1559 is on its way, Ethereum Improvement Protocol. And what this is a proposal to change how gas fees work by splitting them into two parts, a base fee and a tip. Currently, it is an auction, which is whoever pays the most in gas fees, the miners process that transaction first, which favors large players with big pockets versus retail investors. With EIP 1559, the base fee is an average fee determined for each block, and it's burnt on each transaction, and the miner, soon to be the validator, keeps the tip. This will make ETH deflationary, and this proposal will go into effect in July 2021, not long now. Then there's ETH2, Ethereum 2.0, an upgrade to the Ethereum blockchain that will shift consensus from proof of work to proof of stake. It's expected to make Ethereum more scalable, more secure, and more sustainable. Now, the proof of stake chain or beacon chain is already live, and it's expected to merge with the main chain sometime in late this year or early 2022. Now, it's not without its problems, but it could be a considerable improvement over what we currently have. Now, McCormick references an essay called Ether, A New Model for Money, in which David Hoffman, the author, cites a 1997 Journal of Portfolio Management paper by Robert Greer, which asked the question, what is an asset class anyway? Now, Greer says there are three asset superclasses. One, capital assets. These are productive and generate value or cash flow, like equities, bonds, or rentable real estate. Then you have transformable consumable assets, which can be consumed one time, transformed into another asset, and their consumption produces economic yield. Think of oil or other commodities. Then there are store of value assets. These are scarce, cannot be consumed, just transferred, and their value persists over time and space. For example, gold, silver, art, or Bitcoin. Now, in his 2019 paper, David Hoffman argues that Ether is all three, and that with EIP 1559 and ETH2 going live, it can be all three at the same time. So let's look at all three in turn. So as a store of value, ETH can be locked up as collateral for DeFi transactions. Now, you can put up ETH to secure a loan or to provide liquidity to a DEX. And currently, nearly 10 million ETH are locked in DeFi. Then there's ETH as a consumable asset. With EIP 1559, gas fees will act like gasoline in a car. Anytime something happens in the Ethereum blockchain, gas needs to be burned, decreasing the overall supply. Finally, there's ETH as a capital asset. Owning ETH represents a share of the Ethereum network, like owning equity in a company. Once staked, ETH gives its owner the right to do work for the network by becoming a validator and a right to collect fees generated by the network. I suppose the legacy equivalent would be holding shares or equity in a company. You hold those and then you receive dividends. Now, this doesn't mean that Ethereum isn't without its competitors, and McCormick looks at Cardano and Solana, but his main argument is that they don't compete with Ethereum directly. There may be some overlap, but they don't have Ethereum's network effect and its first mover advantage. And in the instance of Solana, they're focusing on a different niche within the cryptocurrency space. Now, I mentioned earlier about Ethereum being ultrasound money. That's distinct from sound money or unsound money. So unsound money is fiat money because it just gets printed into existence and currently at an accelerated rate. So increasing the supply of it, decreasing the value. Now, Bitcoin is sound money because the supply is capped. There will not be any more than 21 million Bitcoins in existence. But ETH is ultrasound money because the implementation of EIP 1559 will mean that the supply is going to decrease because ETH will be burnt in every transaction, and that more ETH is going to be burnt than is being issued every day. So with the supply decreasing, that makes it ultrasound money. So to sum up, Ethereum has strong network effects, and it's going to remain at the center of the Web3 ecosystem as it continues to grow, creating more transactions and more fees. It's going to become a deflationary asset even as demand for it increases at the same time, and it's going to become a capital asset that's going to earn its holders high APR. Now, like I said at the beginning, there's a lot more to this article than I've covered, so I do invite you to check it all out. I'll link to it in the description below, but let me know, what do you think? How does Ethereum rate compared to other platform protocols such as Polkadot and Solana and Cardano? And what do you think of the argument of the bull case for Ethereum? Let me know below the video, and between now and when I see you next, please keep filling your pockets with crypto profits. This is Crypto Rich signing out. All the best. Bye-bye.